Hello, everyone, and welcome to today's Blockworks webinar, The Future of Institutional Crypto Adoption. Today's episode is made possible by Blockdaemon. I'd like to invite our speakers to unmute their lines and turn on video. During the webinar, please submit your questions to our speakers through the Q&A function at the bottom of your screen. We'll save some time at the end of the discussion to answer these. The session will be available on demand, and all registrants will receive an email once the recording is live. I'd now like to turn the event over to Blockworks Program Director, Graham Perry. Graham, please go ahead.
Thanks, Jane, and welcome everybody. I'm excited for this discussion we're about to have today. However, before we jump in, I'd like to give a quick shout out to today's sponsor, Blockdaemon. Blockdaemon empowers businesses to quickly deploy and iterate innovative blockchain applications. They aim to reduce the complexity of working with blockchains through quick and easy configuration, monitoring for high availability and quality service with enterprise-grade security. So I highly recommend you check them out, blockdaemon.com. And thanks again to Blockdaemon for making today possible. So now over to our guests. It would be great to do a quick round of introductions. So Tommy, maybe you can kick us off.
Sure. Hey, thanks, Graham. Tommy Chipman here. I'm the Director of Sales and Business Development for our payments and transactional business. And I've been at Blockdaemon for about 9 months. Feels like maybe 3 years in crypto time. And I spent the last 8 years at Visa in the Merchant Sales and Solutions organization.
Thanks, Tommy. Bradley?
Yep. Hi, everyone. Bradley Reese from checkout.com. I was the Chief Commercial Officer of the organization, but spend almost all of my time now focused solely on Web3 related activities and how we as a traditional Web2 business can bring ourselves and our customers and our partners into the future.
Thanks, Bradley. And Joao?
Hey, Graham. Thanks for having me. I'm Joao Reginatto. I'm VP Product at Circle. At Circle, we build payments and treasury infrastructure for internet businesses on top of these new blockchain rails, and perhaps we're more known for being the issuers of the US dollar coin, USDC, stablecoin, and more recently Euro coin as well.
Thanks, Joao. So to kick things off, maybe I'll turn this one to Tommy. But we've heard the term the institutions are coming for a long time in the crypto space. However, now I think that the institutions are here to some degree, but to what degree is the question. So Tommy, where do you think we are on the roadmap of institutional adoption?
Yeah, it's a great question. I think we're still at the very beginning here. We're starting to see large institutions start opening up platforms. I think a good example would be Salesforce's NFT cloud. I think it's in beta right now. And I think, we can all agree that NFTs were the sort of first massively adopted blockchain Web3 thing. And, I think it was a good opportunity for a lot of major institutions, not only financial institutions, traditional financial institutions, but merchants and companies who might not have thought about it to start to dip their toes in the opportunity. And there's a lot of platforms and companies who are building those solutions for those companies. And now a lot of them are, considering additional ways to use the blockchain. And I think we're just getting started here. I think that the market conditions I don't think that they've necessarily given companies pause. A lot of institutions have looked at it as an opportunity to get in for a lower cost, which is really interesting. I think Bradley would probably have some insights on, what, with all their relationships with, the thousands of merchants that they have, what's the temperature, are a lot of folks getting involved or asking questions? Bradley, what do you think?
We're early. I agree with you, right? So it's fun in this industry in general because things are moving at a pace that we've never seen before. But part of the problem with that is that people get left behind. And I think if you ask the majority of anyone at institutions, the layman on the street, what is crypto, you'll get a variety of answers, most of which won't even scratch the surface of what we're talking about. And I think that's the lens through which we view it as well, is that there's a huge amount of interest, but a lot of it comes as curiosity, but also in some cases with a little bit of fear associated with it as well. And I think that word crypto really needs to be broken down at this point because it means different things to different people. As you point out, Tommy, NFTs for Salesforce are very different than stablecoins issued by Circle, which in turn are very different than soul-bound tokens or running node infrastructure. So I think it depends on which kind of fragment of the broader crypto sector we look at. it's all still the same trend. We're up and to the right, even if there's the occasional blip, which obviously happens in this industry from time to time. I still think that the underlying value of the technology is now starting to be teased out. And I think that's really what it's going to come down to, is if we can answer the question succinctly of what problem are we solving, we'll start to see these applications start entering the real world. And that's a great opportunity to hand it over to Joao, because while NFTs definitely brought a lot of consumers into the space for the first time, I think that stablecoins are going to do exactly the same thing for institutions.
Yes, I completely agree with Tommy and Bradley. I think it's still very early days, but this is actually a pretty interesting point in time for the market to also ponder on that question, right? I think I have been asked this question in the recent past, with this correction in crypto, with the bear market, do you guys see any slowing in sort of institutional adoption and institutional use cases? And I agree. I think Bradley and Tommy both touched on this. We actually don't see any slowdown. If anything, it feels that there's a little bit of a pickup in pace of these conversations. Obviously, this is very different from crypto native companies and early adopters, right? The conversations tend to be much more lengthy, and the due diligence is significantly more sophisticated, right? But I don't feel that there's, my impression, at least from my vantage point, is that there's no slowing down. And in fact, a lot of what happened in the last 12 to 18 months, which was, also frothy, perhaps on the institutional side as well. I think there was a lot of adoption of crypto assets as an alternative asset class for treasuries, for fairly large corporates and institutions. I think that part honestly has been scaled back because of all the crises that we have seen in crypto capital markets, and basically a credit crunch and everybody calling back that capital. But at the same time, it has allowed institutions to experiment a little bit more in a different type of use case with these assets. And I think folks continue to be extremely sophisticated, as I said, in the due diligence that they're making. To the other point that we touched on, yes, stablecoins, I think, continue to be a killer use case for institutions as well. I think they do understand that now more and more as an alternative rail, right, an alternative platform whereby you can build use cases, you can build financial services on top of. But there are still so many points to be answered, and I think we're going to touch on those today, that it still makes me feel that it's very, very early days, and we have to, as an industry and as providers of infrastructure in this industry, we have to focus on the pain points, on the opportunities, but address a significant amount of very hard questions when it comes to privacy, to identity, compliance, a lot of things that we still have to answer.
Yeah, I think I'd love to add one thing there and bring up a really good point, Joao, is that a lot of these companies are coming to Blockdaemon and saying, we want to do something in Web3 and in crypto or in blockchain. What should we do? And I think that for all of us here in the Web3 community is understanding, like, what are really good use cases? There's still a lot of unanswered questions. And I think that, the first step is having these companies come to us and ask those questions. And then we have the responsibility to, understand how to answer them, and also be okay with saying that isn't relevant because X. Like there isn't, an example would be like, there isn't a processor. The blockchain is a processor. It's a distributed network that does that. And maybe there isn't a settlement, or there isn't, something that would normally exist and that institutions are comfortable with, and getting them to think sort of outside the box, to understand, no pun intended, with blockchain. It's to get them to understand that this is sort of a new frontier, and we can solve problems in ways that we, previously hadn't thought of, and then making them comfortable from a regulatory and security perspective. Blockdaemon just announced its ISO 27100, which is a, really huge milestone for us as a company, to be able to have companies be comfortable with us, sort of getting into the compliance and regulatory fold.
Thanks, everyone. I think that was a great way to start. And just to summarize, we've seen some legacy institutions enter the space, and I feel like it's somewhat comforting to know that the institutional appetite hasn't necessarily slowed down in these current market conditions. And I know we touched on a few use cases, but I'd like to dig in a little bit deeper and hear from you, like, what specific use cases do you think are the primary adopters or primary drivers of adoption with an institutional focus or lens to that question, of course.
Yeah, and maybe Joao, you can start, because I think, there's obviously a lot of things happening with USDC and a lot of announcements, and I think that you probably have some good examples of what folks are wanting to do with USDC, and I think that we would all agree here that stablecoin is the key thing that will remove barrier to entry for enterprises. And so understanding what they're wanting to do with stablecoin and what their comfort level is a good place to start.
Yeah, let me start, and I'm sure there will be a few hooks for areas that you guys are very much interested in. So a number of things that we have seen, right? And obviously we're talking about institutional use case, but there are some things that actually, touch the way that institutions also deal with startups. And I think that's an interesting space there, because, startups, and particularly crypto native startups, they are more sensitive to this technology, right? They tend to have a lower barrier for adopting them. One of the super interesting use cases that we have monitored on our side that I think not a lot of people are aware of is in the crypto capital markets in the very early stages of companies, right? So there are a significant number of venture capital funds and other types of funds now investing, continuing to invest in companies where the plumbing for all the investment that they do today, so the initial wires, the initial funding that they extend to these companies is all running on top of USDC rails today. We see so many startups that, are working with a particular fund, and they set up a USDC wallet before they set up their first bank account these days. And we see that scaling a lot because it's being driven by the funds, right? So the funds are now beginning to tell these companies, hey, this is how I'm going to give you capital. Are you okay with that? So that's a super interesting use case. There's a lot of interesting scale there that I think we don't talk a lot about. And I think that's super interesting because, in a way, things like stablecoins, they are very, very foundational in nature. They're pretty much at the bottom of this layer, right? And so beginning also at the foundation of what a company is at the very start and growing from there, from these institutions that are associated with that phase of a company, I think it's an interesting thing to think about. Then I think in payments and settlement, it's also a space, I'll obviously leave it to Bradley to talk a little bit more about that, but it's also a space where we see tremendous amount of growth. I think, Checkout has announced, a notice support for that kind of technology on settlement use cases. I think we see a lot of interest. As Tommy said, a lot of companies come to us and they ask us how to do that, and we're happy to, direct them to Checkout or direct them to other companies who are then growing these types of capabilities. But settlement, whether it's payment settlement, but also we see a lot of work being done for the settlement of other types of use cases that are quite large in size, right? We see a lot of things like equity swaps, being done on chain, sometimes in private chains, but already being done on chain, and people talking about, okay, but now isn't it cool if we actually also move the settlement of those trading operations to something like a stablecoin? So we see early adoption in there as well. I think what happened with permissionless innovation on DeFi, on capital markets, on the lending and on the borrowing side, we see a lot of institutions now trying to utilize that technology. Again, sometimes people are investigating that in private networks, but I think there's clearly a lot of innovation in terms of the cost of capital and the effectiveness of the capital when it comes to implementing lending and borrowing in that way. And the final thing that I will mention is also foreign exchange, FX, in the various types of needs for FX that are there. But I think bringing now a significant number of and a variety of different stable coins, different fiat currencies on chain, it creates this opportunity for, again, permissionless deployment of liquidity, which I think is something that we have seen from large scale institutions, even banks, saying, we have capital here, we would like to deploy to some of these markets to facilitate FX from a liquidity standpoint on chain. Now there's a lot of problems, and we'll talk about the problems later, but there's a lot of problems then with counterparty risk, identity, compliance, all those things, but at least the use cases, we see seeds of adoption and experimentation.
Yeah, and I like that you used the example of investments. I actually made a small investment literally a couple of weeks ago and had the option of using my bank account, fiat or USDC. It was over the weekend, so I could go to my bank and pay $10 for same day ACH that would actually clear 3 days later, a wire that would still clear 3 days later, or just a free, pretty much instant transaction that I could send wallet to wallet. And again, that same lens of what problem are we solving, check out the role we play is to really try and find solutions that improve quality of life for our merchants and subsequently their customers. And the two examples that I like to use to paint the picture as it pertains to stablecoins specifically are one around liquidity. So yes, we support USDC settlement. We're very happy to do that. But one of the problems that we're solving with that, of course, is that we're now able to settle 7 days a week. So previously, if you are in a money remittance business, for example, even a TradFi, so you can imagine the Western Unions, the MoneyGrams of the world. Of course, MoneyGram announced USDC as an option now as well. I think they launched that last month. Their value proposition to their customer is that they will move money instantly around the world. Of course, they don't actually receive that fiat if someone's using ACH, bank rails, a debit card, what have you, if the transaction was to take place, let's say 11 p.m. on a Friday night. So they have to bridge that liquidity. And the way that they do it typically, not to speak for all of them, is that they have different operations globally around the world. They balance liquidity in different markets, which means they need to have extensive localized operations. There's huge sunk costs in establishing this. And then, of course, there's ongoing overheads in maintaining that as well. So if you imagine a world where instead they could send USDC, the liquidity stock problem is basically solved. And of course, if we can provide them with those funds Saturday, Sunday, and in future, probably in real time as well, it's really a paradigm shift. It's moving what has been, a settlement network for the last probably getting on for almost 100 years now that's only operated on banking hours, can now operate instantaneously due to the power of technology. And then maybe a more sort of, retail example would be, imagine a gig economy company, especially one which is internationally based. The examples I like to use here are kind of the freelancer companies. So Fiverr, freelance.com, Upwork. A lot of the time it's someone in an emerging market interacting with maybe an SME in a developed market like the US. That young SME company has capital concerns and wants efficient, web development work done. So they outsource it to someone in Argentina or Kenya or somewhere else around the world where it's cheaper than a local resource they're able to find. Again, if you think about the way that model typically works, funds would be held in escrow, and then they would be wired to that, the seller, effectively the provider of that service. If someone's getting, say, $100 commission, you could easily see a $35 wire fee, a 5-day settlement time. If they've accidentally fat-fingered their bank account number, the money never reaches there. Of course, everything on chain is fully auditable as well, so it's actually very secure. I think that's maybe a misunderstanding today around blockchain, is that it's not full of fraud. It is actually very easy. There's some great companies obviously working on security and being able to trace addresses, which Joao obviously plays into that sort of identity requirement and KYC that we'll probably come on to a bit later. But again, you're thinking about someone in an emerging market who wants to receive the maximum amount of value. They can get $65 on their $100 5 days later, or again, using something like USDC, they can receive $100 on $100 instantaneously. And then, of course, that plays into some of the other things you're talking about, which is, well, if they're already custodying USDC, what sort of synthetics could we build around that? Obviously, USDC is a synthetic of the US dollar, in the same way that you could also imagine a future where maybe other equities, commodities, different sort of trade vehicles would be made available on a global basis to people who haven't had access to these sort of capital markets previously. Again, that's a deep rabbit hole, so I'll pause for a second there and then let's talk for a bit.
Yeah, and I think there's two really exciting points there. One, I think what we're seeing from a Blockdaemon and institutional perspective is there's a lot of really large VCs and companies that have a lot of digital assets locked up in staking. And there's a huge demand for liquid staking to be able to get those funds out and go and make them productive. So there's this, Blockdaemon has recently rolled out our liquid staking, in partnership with Stakewise. And I think that it's really interesting that we're seeing a lot of demand for companies to get access to the liquidity to go make other investments or go do other things. That's really interesting, and it's pretty esoteric, right? It's a very complex tool, and I think that it's interesting that we're trying to make it easier and making companies more comfortable with, hey, we have this opportunity to potentially earn yield, but we're not locked in forever. If there is an opportunity for us to pull out our liquid and go and make additional investments. I think that will continue to speed up the overall innovation of these VCs and companies who are comfortable with making investments in this technology. It'll allow them to continue to do that. Bradley, you mentioned this marketplace opportunity, and it's one that is near and dear to my heart and I love. And I think that USDC plays a huge role, especially, I think that there's sort of a carrot at the end of the stick there where I love the example of like, Fiverr or even a ride sharing company who has clients all over the world. If they could accept and get paid in USDC, well, what's from stopping them to using tools like, Circle's treasury and earning 4% on their USDC? And I think, companies like Checkout and Blockdaemon can help these companies get access to blockchain. But once merchants globally start being able to accept USDC, through a QR code or whatever that may be, I think that we'll really start to see the power of blockchain, right? Like, hey, now that you can accept these, digital assets, merchants really start to reap the benefit, lower cost. Like Joao, you mentioned FX fees. Well, what happens when those, start to get removed? And now instead of a cost of a transaction being 3.5%, it goes to 1%. And your customer actually has a white labeled wallet with you and is earning 4% through Circle Treasury. I mean, wow, there's a lot of doors that open there. And I think a big step is regulation. We got to get there, and companies have to be comfortable. And I think, Pat Toomey has his, bill sort of circulating around around stablecoin regulation, which I think a lot of folks in the industry like it. And I think that there's a lot of interesting things in it. But I think that is a major step, and getting some regulatory framework will really help institutions be comfortable with starting to experiment even further in market.
Yeah, and the good thing is it looks like we're almost there.
Yeah.
We're close to defining what a stablecoin is, which I think was step one. And it looks like they're basically describing USDC and some other variants, of course, as well. Once the definition's in place, it allows for that framework to be established. So yeah, I mean, the regulators have a huge enabling role to play here. Yeah,
and I think that, and Joao, you might have some interesting insights here, but the fact that some of the things in that bill include sort of specific details around how a retail bank could start their own stablecoin, and that's really interesting. That it has to be separate too from their funds and from their overall infrastructure, and that's a lot of where Blockdaemon can come in. We are a sort of one-stop blockchain shop, and I hate to say it, but sort of Amazon Web Services of blockchain, right? So you have this capability to be able to come and host nodes and get access to all these additional tools. And I think that that's really exciting, and that, hey, they're separating it and reducing risk and making banks feel more comfortable, and overall the general public. I think a good point is we're still at the point of there's only about 45 million Americans who have digital assets. I don't know what the stats are for the world, but we're starting to get to this tipping point, right? I think there's something like 180 million Bitcoin wallets. And as we continue to sort of go down that path, there's this really exciting opportunity to continue to experiment. And that bill, I think, is a huge opportunity.
Absolutely. And yeah, just to kind of circle back, Bradley, I think you made a really great point, and I like the way you framed it, addressing what problem we're solving, and just like your one point about liquidity, like it makes complete sense for like corporate treasury that, like you said, might be international. They'll keep liquidity or capital all over the world. Like just the benefit of being able to have that at the top of the house, instead of all over these different jurisdictions, and like have better networking capital and this instant settlement time. Like it seems like a no-brainer. And Tommy, just to go back to your other point, and I know we kind of touched on regulation, and I want to move into that, but you did mention, increased user adoption, and only 45 million people in the US having wallets. So what would you say is like the main driver for some of these legacy institutions to adopt? Like, do they see an area of opportunity that they're addressing, or is it based on consumer demand?
It's a really, really good question, and keeps me up at night. I think that sometimes it's a question that the institutions are asking us, and I think we still are defining what are the opportunities. I mean, there's some clear ones. We can have decreased costs, and there's an opportunity to potentially reduce costs from like an interchange perspective, or FX fees, as Joao mentioned. But there's still a lot of unanswered questions, right? And a lot of these institutions are asking us to define blockchain in an analogous way to traditional finance, and it's really hard. Like, who is the processor? Who is the financial institution? Who is the network? Who solves chargebacks? Who mitigates XYZ. And a lot of those are still unanswered questions or not relevant. Like there isn't an answer to them. And I think that we need to educate and understand who we're educating. Are we educating executives? Are we educating the general public? Are we educating lawmakers? Or are we educating the sort of IT, teams? Are we getting them comfortable with, getting into a developer environment where they're, making calls to a Bitcoin node to do audits? Like what we're seeing too is companies starting to experiment with private networks. So before they get involved with a public network is let's build a private network at our financial institution, and let's try to move funds from one branch to another, or from one customer to another with a private permissions network. And what does that mean for our institutional investors, or what does that mean for our enterprise clients? And I think that that's a really good step too. But I think that the goal, and we were chatting before, I think Bradley mentioned this, is the goal is to get everybody to a public blockchain, right? And because the true sort of power of Web3 lays in that space, but we're still defining what are the baby steps, like what are the things that we can do to get institutions and their investors and their overall boards comfortable with this technology.
Yeah, I mean, cross-chain interoperability is not exactly there today. Wormhole or bridging, I mean, there's been too many exploits. The thing is, you can obviously, like USDC, we should keep track of the number of times we say USDC in this call, but like USDC, just start saying some others. But obviously, it does run on multiple chains, which is great. And of course, there are ways to kind of bridge it across relatively efficiently. But it's not just the regulatory side of things. We also actually sometimes, forget that we live in a ridiculous multi-chain world, which is debatable whether we need to have, 1,000 L1s or L0s or L2s or anything else. But that is a challenge because, of course, if you're on a private network, there's obviously efficiencies that come with that. I mean, even JP Morgan are experimenting with it internally about moving funds across their own organization. But at some point, you do need it to be truly interoperable and ultimately agnostic. And I think that that's kind of what I'm looking forward to the regulatory position clarifying is, can a bank recognize USDC, say it one more time, as a US dollar equivalent? Because I think that's going to be one of the big things that opens the doors, because right now crypto has a big problem on both ends of the spectrum. It has a first mile problem and it has a last mile problem. The first mile problem is that most value in the world does not sit in a digital asset format. If you want to get USDC, BTC, ETH, whatever it is, Ether, sorry, you have to move money from a fiat source, and there is friction there. There's cost, there's time. So there's that one-time sunk cost of moving 1,000, $1 million, $1 billion into a digital format. But then equally, using that gig economy example, the other end, it's all well and good for me to send USDC to someone in Argentina where, they're seeing 60% bond yields because their currency is inflating at such an aggressive rate. You could argue that someone in Argentina probably wants to have USDC, not the Argentinian peso. But if they want to go buy something, they're probably going to have to get pesos. So how do they get it out of that wallet? Is it that QR code? Is it something else? And maybe, Joao, this is the FX angle here, but how do I trade my USDC to something which I can use locally? When is there going to be a peso equivalent of a digital format that will be recognized in a convenience store in Argentina? So there's still these sort of pieces that need to come, but I think the proliferation of multi-denominations of stablecoins is a key part of that. You could argue we need, 1, 10, 20 USD variants. Fine. I think what's more useful at this point is actually expanding to try and represent, again, a synthetic version of every other currency in the world so that you get interoperability and exchange, not just between chains, but also between currencies in real time, potentially, again, in a DeFi environment.
Yeah. Well, on that topic, I have no problem counting the number of times you mentioned USDC. I love that. I love that because it just means, we're almost getting to a point where, we are going to have a version of the dollar that is really digital in nature, and hopefully more and more, whether it's USDC or not, begins to become more of an implementation detail. I think that's part of where we need to get to. But I think the guys touched on so many good points. I want to go back just to regulation a little bit because particularly stablecoins have been a topic for a lot of scrutiny over the last few weeks, right? There's a lot of fear, a lot of uncertainty, a lot of doubt that has been created within crypto capital markets itself. And I think I think the industry and, Circle, we would like to think we have done a good job in sort of, doing as much self-regulation as we can. Trust and transparency is one of the pillars that we have always had when we designed, this kind of product. We continue to try and, set the standard from a trust and transparency point of view. But also, I think that there are some things that can only be answered by regulation, right? For example, there's a lot of questions that people have been asking recently about, bankruptcy situations and whether those funds in a stablecoin construct like USDC, like who has a claim on those things. And unfortunately, I think what most people don't understand is that bankruptcy laws are really, really complicated, right? They're really, really focus on being fair in general. So they don't have like generalized answers for these things. And I think therefore what we need is just more clear regulation. So we very much welcome the regulation that will come. I think everybody expects that it will. It's just a matter of time now to come into that space, because then all of these answers, they can be, more black on white, and they don't need to be down to all this speculation that happens on Twitter and all these things. You will have a concrete answer, which, in a lot of cases, we just don't have today. The other thing, I think Bradley touched on this, we definitely need an answer for what an asset class like a stablecoin like USDC that is, fully collateralized, how do institutions interpret that from a balance sheet point of view, right? If they all of a sudden store that and custody that as part of their balance sheet, what is that? Is that the equivalent to cash deposits? Is that the equivalent to, some investment that they have on other funds? Like there needs to be clarity on that. Otherwise we're not going to get beyond like the level of adoption that we have today. People will continue to experiment, but they will sort of be blocked or be gated at that, production phase. So I think it's very important, despite what some people say that regulation will curtail this space, I think it will actually we will see this as the milestone, the gate that when we go through, it all of a sudden unlocks all of this set of opportunities. But I wanted to go back to something that Bradley touched as well, because I really think it's very, very aligned with the way that we think about things. I think we have been positioning ourselves in the more recent past, even though it has always been the case, how we thought about stablecoins in general, is that they're actually platforms, right? I think a lot of people focus on the bare asset side of what a stablecoin is. I can hold it, I can transfer it, and that's great. But the most interesting part actually is the fact that they are composable, that they're extensible, they are interoperable, because that means that they become a platform and people can build on top of that, right? So, and it can begin by simple things like, Blockdaemon supporting, maybe the custody of that, or Checkout.com supporting the settlement for an asset like that. But over time, I think when people get more sophisticated, and particularly then when these platform tools for developers become easier, then we should see a lot more innovation. And I think effectively what we were talking about, bringing more settlement use cases, bringing more layers of identity with privacy, bringing foreign exchange. I think there's an opportunity for collapsing a lot of those capabilities further down on this technology stack and make them actually be super close to this asset layer that stablecoins are, in a way that then it becomes super easy for Checkout.com to innovate on top of that, for Blockdaemon to innovate on top of that, for an ecosystem to be created in a way that, as Bradley said, we don't need to think about USDC on Ethereum versus USDC on Solana bridging, right? It still feels that we're very early, and those are all implementation details that shouldn't really surface for a developer within an institution trying to work on top of this platform. That's why we care a lot about distributing USDC on all these ecosystems, but also we're doing some work now to kind of coalesce them back again and make sure that we have proper interoperability layers, so that if an end user or an institution has $100 on a particular chain, and the counterparty or the merchant that they want to transact with, prefers settlement of that asset on another chain, that they can still interoperate and they don't need to be aware of all these implementation details. And I think, as we said, this has so much that we want to innovate and evolve the industry from a partnership and standards point of view on things like decentralized identity, on things like privacy. I think we have all the building blocks from a technology point of view, but we still have to put them all together and expose this at the right level of abstraction for developers.
I've got to ask, because we haven't actually mentioned another four-letter acronym, CBDC. I mean, it's funny because obviously some regulators in certain markets have obviously looked into this, and it looks like, we're going to have some progress on that front as well. I mean, I'll just ask you straight up, Joao, but does USDC coexist with a federally issued CBDC?
It's hard to say, right? Because all these CBDC models, they seem slightly different, whether they are going to be retail facing or not. But I think in general, the perspective that we have is that yes, they will be interoperable, because I think, I think we live in a world today where, the way that I qualify mentally is that today we're living in an electronic money world, right? And then we're entering this really digital money world. Today, it's mostly around electronic money, and you have some companies that are regulated for being able to issue this electronic money. I lost track of what I was going to say.
What? Yeah.
Oh yeah. So the interoperability, but a lot of these electronic money solutions, they are driven by private entities, right? So you go to PayPal, if you want to consider that, you have some sort of PayPal dollar in those applications, right? You go to a bank, you sort of have their private version of electronic money over there, and then you have like the government issue money that has M1, M2, and all those layers that sometimes don't come even close to retail usage of that, right? And eventually you get to cash, and there's also that's also another form of money. I think that's what we will see. That model is basically what we believe we will see in the digital form of money as well. You will see private versions of stable coins, things like USDC or other versions of it, that will have a lot of retail and business use cases associated with it, and there will be a space for CBDCs, right? And maybe there's a lot of bank-to-bank use cases, maybe there's a lot of bank-to-Fed use cases that are going to be super optimized with the introduction of those products. But we very much see the potential for these things to coexist. Absolutely.
Yeah, one thing I think we would be silly to remiss here is that the on-ramp space. So, Blockdaemon acquired Gem about 6 months ago, and obviously there's plenty of really incredible on-ramps out there, MoonPay and Wire and Transact, Ramp. And I think an interesting trend is we're seeing those technologies get really, really good. And one thing that's been mentioned to me before is that the user experience of digital assets in crypto and blockchain hasn't really been there. And I think we're turning that corner where on-ramps and off-ramps are becoming what everyday people and businesses interact with. And, we like USDC is our #1 asset purchased on our on-ramp. And that's really interesting to us. And, what can we do next? Like, how can, what features and functionalities can Circle provide to, companies like Blockdaemon who say, hey, we have this, API, REST API that you can, do these additional tools. And I think it's sort of the future of the payments gateway, right? And, what did we see with payments gateways? We saw individual payments gateways who did one thing at a time. And then you had Stripe come into the space where they put everything together. And then you really started to see all these incredible use cases where businesses could turn on really simple user experience, not only for their end users, but for themselves. They could turn on all these tools that give them access to, easier reconciliation and better understanding of flow of funds. And I think that the on-ramps are getting to a point where they're going to become that. And it is the sort of gateway and gateway, no pun intended, gateway to being able to provide those services, to connecting the enterprise to their end customer with a pre-built user experience that is easy and comfortable for people to use. And I think that it's really exciting because it's happening fast. We keep seeing additional feature functionality added to these companies. And, I wouldn't be surprised if we started to see, bundled white labeled wallets and custodial services with on-ramps where you as a merchant can go to an on-ramp and turnkey have a white label wallet where someone can easily go and purchase a digital asset like USDC or even, purchase something like Polkadot or Solana and then do things after that, like stake it or easily go buy USDC and then, go perform a function with a USDC. And I think it's our responsibility to provide opportunities and applications for people to apply these tools to.
Yeah, I mean, as you mentioned, PayPal, obviously it feels like ancient history now, but it probably was only a couple of years back when they made the big announcement about cryptocurrency, and everyone misunderstood what it actually meant. It wasn't like you could actually pay with cryptocurrencies using PayPal. It meant that you could buy them. They would probably make a generous spread on that as well, and then just effectively hold them. But of course, a natural next step would be, and you think about it from PayPal's perspective on the B2C angle about user retention, adding additional value. Obviously, something that Blockdaemon is famous for is node infrastructure. If you can earn whatever it is, 5 to 12% in APY effectively by holding cryptocurrencies, then you're actually adding value and providing services that don't exist today. If you have a long view on the crypto industry at large, then really, any proof of stake network that you're interacting with, it's the best way to earn APY that's probably ever existed. Buy and hold is still not a bad strategy, and certainly Bitcoin hasn't performed badly in the last 10 years. But if you can earn a consistent kind of return on the investment paid in kind, ether for ether, by staking it after the merge maybe happens, that's where I see kind of additional value that just didn't exist before. It's kind of manifested value that is a brand new arena. That's probably one of the issues with adoption in general, is that it's brand new. They're in the same way that regulators are trying to maybe use existing frameworks, which don't necessarily apply accurately to what we're talking about when it comes down to distributed ledgers and blockchain. I think the same applies in terms of actually the end value. Again, that same lens of what problem are we solving? Or maybe another question to say is there incremental value we can add versus what exists today?
Yeah, and one really interesting part, and that's a really good thought, Bradley, is that the incremental value, some governments and institutions, they are concerned that there's incremental risk involved. And that's actually something that, Blockdaemon has been, spending a lot of time having conversations with regulators, large institutions. Our investors are, JP Morgan, Citibank, SoftBank, and a lot of them sit on our board. And what we're doing is working to build this framework of risk. Like, there's inherent risk with any network. There's inherent risk with using, Visa, MasterCard, Discover, American Express. There's inherent risk with using Zelle or any of those others. And we're trying to, have this conversation around, hey, this is a network, it's a public network, and there's inherent risk, but here's the things that we can do to reduce that risk, whether it's, insuring stake funds, or providing KYB and KYC, which I think is something that is really interesting and also sort of butts heads with the overall ethos of blockchain. Like, hey, there's anonymity and being synonymous. Well, how do you KYC someone? And like Gem, for example, has a KYC network where if you KYC once from our on-ramp that's on any merchant's website, you don't have to KYC again. So back to that user experience, which relates to risk, which relates to value.
Yeah, it's an archaic view. Sorry, Graham, I can see you desperately trying to kind of interject and course correct us here. But on the last thing I'll say on the KYC point, because it is a pertinent one, is KYC is a bit broken. Me as a Bank of America customer, if I go to Chase, they have to start the process from scratch. And I think there's optimizations that we'll see there, which again will help improve user experience, reduce friction, allow onboarding of new users to equity trading, whatever it may be, if we can solve that. And Joao touched on it earlier as well. These are very valid concerns. I think the purists in Web3, and this is why I do think that there's actually place for still a lot more decentralization, including when it comes down to actually stable coins. I don't think UST was a good example of it, but I do think that we're going to see more arise in the future. There is a purist view around, I don't want anyone having access to my data, but KYC exists for very, very good reasons. And I think things like, soul-bound tokens, I think decentralized identity, you could imagine a future whereby a user self-custodies an SBT, which is effectively an NFT of sorts, whereby you may plug into a government-run database, pull your IDs, your driver's license, your marriage certificate, your university degree, and then you can expose that data to any DApp you interact with selectively, but based on your own volition. So you're still the one in control of this, but it's again a marriage of kind of centralization and regulation, as in a public government database that provides you with, again, that irrefutable proof via an NFT that links into your broader SBT that then you can take to future organizations to interact with them. So things like this, we're just scratching the surface on it. So, that's one of the areas which I think is going to be a great enabling factor as well, is addressing that sort of important KYC, AML, CTF concerns that obviously institutions are naturally going to have.
Yeah, self-sovereign identity, and I know I'll let you jump in here, Graham, but self-sovereign identity to me is one of the most exciting opportunities And I'm really, really curious to see where it goes and to see institutional adoption of that, because it will drive institutional adoption of decentralized finance.
Yeah, and thanks so much, guys. Honestly, this conversation has been great, and I'm sure we could go on another 45 minutes very easily. I just want to make sure that we save some time for audience questions here at the end. So yeah, just to the audience, if you do have any questions and haven't submitted them yet, please do so in the Q&A function. And then just before we do that, Joao, before we move over, did you have any other responses or closing thoughts you'd like to add?
I would just, pick up on what Tommy and Bradley were mentioning. I think decentralized identity, this idea that you can, verify your identity with some provider, get a cryptographic proof that then you can hold on chain on your wallet in any form. It can be in the form of NFTs or not. But that bring it to all these use cases in a way that you bring the proof, right? You bring a credential that somebody has attested to that you are who you say you are, but you don't bring your data anymore, right? And so your data might be protected in less and less and less places. That's a tremendous opportunity. We have this project called Verite that we are part of. As part of the Center Consortium, because we think that it's tremendously associated with stablecoins and unlocking other use cases. But interestingly enough, I also think the privacy side of things is also super important as well, because for institutional use cases in particular, all data, all history of balances and transactions available on chain is not going to work for a lot of use cases, right? I don't think Goldman will want JP Morgan to see all of their books open on chain all of a sudden. So I think also having a level of privacy then of those on chain volumes combined with decentralized identity and done in a compliant way, so that maybe regulators have an escape hatch where they can actually look inside and see what's going on and be comfortable with it. I'm excited about the combination of those two things for institutional use cases.
Great.
Yeah.
Sorry,
Go
Tommy.
ahead. No, I was actually reading some of the questions, but go ahead.
I was just going to say, I think that was a great time to transition over to the Q&A portion. So this first question here, and I thank you again, all of you for your thoughts and conversation. I found it very enlightening. So our first question here from Alyssa is, I guess this one's for Joao, but what are the tax implications for businesses accepting payment in USDC? Or if I just add on to that, is it any different than accepting USD?
It shouldn't be any different from accepting USD or accepting other forms of crypto payments in general, which tend to be liquidated immediately. So there are certain things that come from crypto payments that are not in the form of stable coins, right? Because when you liquidate it, you might be having a gain on that, and there are tax implications there for either the buyer or the seller. For stable coins, because you don't have a gain, it's always worth $1. It's a little bit less complicated, but yeah, there's a lot of companies working on clarifying the frameworks there for tax, but it shouldn't be any different than other types of payments.
Thanks, Joao. This next question, I guess we'll just open this up to the whole floor, but what is the turning point in crypto adoption by institutions? So I guess, is there like a watershed moment that we'd be able to point to and say like that was it? Or is it just, I don't know, I'll leave it to you.
I mean, I think the passage of regulation in the US, we're seeing some signals in Europe that that's happening. Bradley probably have more knowledge on that than I do, but I think that that's a really, really big turning point. Even just the fact that there's conversation and that there's a bill circulating is incredibly important. And there's another question here that sort of relates to that, which is CBDCs. And I think that like the overall language from the US is that we want stablecoins to essentially be analogous to a CBDC, where this law would essentially encourage, or regulation would encourage, banks to have their own stablecoins and to regulate it with federal licenses and so on and so forth. So we're actually seeing sort of the true market forces either replace or redefine CBDCs. And will there be CBDCs? Like, absolutely. Like, I think that will just be a natural function of how it works, but there will be alternatives like USDC.
Yeah, if I had to choose one, I'd agree with Tommy. It's going to be the regulatory opening up. Because again, right now, if you're under GAAP, like, generally accepted accounting principles, or if you're a federally regulated institution, it's a bit of a mystery. There is no framework. That's what's prohibiting a lot of these organizations getting involved in the space. And when I talk about last mile problems, I mean, that's what I mean, that if a bank in Argentina could recognize USDC and even, let's fit into their box and they can convert that at a 5% markup to the local peso. Well, okay, at least there's now an off-ramp for them, which links into the existing networks in place. So that will probably be the big aha moment. And I think the US inevitably will play a leading role because, of course, especially as it pertains to stable coins, they're almost all denominated in US dollars today, maybe largely because that's the global reserve currency. But I also think it's important to look at it through different lenses, right? I mean, I think, the DeFi summer or NFT revolution, I mean, all of these are evolving parts of the industry. So I think kind of broad brushing and saying what is the watershed moment is hard to answer because it really depends on what problem we're trying to solve for. Things like identity, we haven't even started that yet. That will probably be a few years down the line. But the Financial Stability Board is meeting again in October, which is basically almost like a conglomerate of federal banks and treasuries. That will be interesting. I think we should keep an eye on what the outcome of that is. But in my mind, it's only a good thing that this is even on the docket for them to discuss, because that definition is the first step towards a regulatory framework, which is the precursor to broader financial institution adoption, their ability to custody, exchange. And of course, that brings in their downstream customers, be they consumers on one side or institutions and businesses on the other.
Yep. And one really quick piece to add to that is, I think the next sort of watershed moment after regulation is seeing retail and institutional banks or even challenger banks allowing their retail customers to buy, sell, hold in this similar environment to their fiat. And that's like essentially now we're saying, great, now you have this place, your bank account is also a wallet. And that's where, institutional custodians are playing a huge role. Folks like Fireblocks and Mataco and Anchorage and making those banks comfortable with that. And that once banks get the signal that they can have digital assets on their balance sheet, and we start with something like a stable coin like USDC, is, I think, the next huge watershed moment.
Thanks, Bradley. Thanks, Tommy. This next question, I think your answer kind of leads into this one, Tommy. But Paolo says he works in the U.S. industrial construction space, $1 trillion industry with high volumes of transactions. Are you seeing emerging use cases for a market such as this? And maybe I'll caveat that by saying, removing the regulatory piece out of that. Like, do you think like the stablecoin market is ready to do such volumes?
It's actually really interesting and timely. Great question, Paolo. Is why I was having a conversation with a startup who's using the blockchain to free up the commercial real estate and building business. So there's all these commercial builders out there who are building homes, but what's slowing them down is the speed at which they can get capital. So, I'm not gonna preach about it because I don't know a ton about how that institutional market works, but there's an opportunity to use blockchain to speed up the transition from money from a lender to a builder, to general contractors and to contractors in general. And the faster we can do that, the faster homes can get built. So like very clear use case. What they're running into problems is KYB. How do they KYB all of these, contractors and institutions, and then off ramps? Are they comfortable with USDC? Like, what does a contractor who goes in and does electrical for 100 homes? They don't have use for USDC at this point. So they can get paid in it from the blockchain, but then how do they off ramp? And I think that's what's really interesting. And there's definitely a huge opportunity there, especially in capital markets, to be able to speed up the time in which someone makes a loan and gets paid, and then the actual service gets built. And I think that there's a huge opportunity in that space to do that.
Thanks, Tommy. This next one I think is for you, Joao, but it is, what is your views on the systemic risk of one stablecoin issuer providing several different currency-backed stablecoins?
It's something that we care a lot about. That's why, as I said earlier today, there's a lot of questions being asked from us as an industry about quantifying risk and making sure that there is transparency across providers of these types of assets, so that people can quantify the risk and therefore trust on this type of platform. I think there's definitely some level of systemic risk when these things get very large. And so that's why I think we welcome regulation. We want to make sure that people can have clarity over the topics of the day, bankruptcy, counterparty risk, all those things. We have our own, self-regulatory approach to this, in the way that Circle has always designed the build out of an asset like USDC, and also Eurocoin now, doing it from a regulatory, very clear position, e-money in the US, for example, for something like USDC, with US based banking partners, never running away from how we thought we should be regulated, and actually asking for more regulation. But I think there's more, because otherwise a space like decentralized finance, right, relies so much on an asset like USDC. We want to make sure that the space can continue to trust USDC, can continue to be comfortable with the risks involved.
I think, you give a very balanced answer to that question, but if you look at it take a step back, like banks today can lend out way more than their assets under management. So in many ways, banks with US dollar and fiat could take on a hell of a lot of risk to obviously issue debt, and obviously debt creates revenue for their bank. With USDC, not all stable coins, they're not all created equal, but I think that's what that definition will help us establish, is that they are one-to-one or one-to-one equivalent back cash equivalent, short-term commercial paper, high-value treasuries, etc. In theory, if you're issuing a euro stablecoin or a Canadian dollar stablecoin or a GBP, as long as you're still using that mechanism behind the scenes, and of course that there's an element of how do you custody the asset, etc. But that provides kind of inherent security that there is no bank run when it's a one-to-one issuance space.
Yep.
Very good point. And I know we're running up on time, so I think that was a really great question to end it on. So I just want to thank all of you again for your time today. It was a great discussion. I know I got a lot out of it. I'm sure the audience did as well. And sorry we didn't get to all your questions, but to the speakers today, Bradley, Tommy, Joao, thanks very much.
Thank you.
Thanks.
Thanks everybody for joining. Appreciate it.
Absolutely. Take care.